me, David, and good afternoon, everybody. Price Headley here from BigTrends.com. Thrilled to be with you. Figure we'll start with an overview on my take on the markets, and then we can look for your individual comments as well about what else you want to take a look at here in the chat. Let's see if it'll let me drag it over here so I don't have it in the way. Make sure I pick them up. Pop in any symbols you want to look at. I'll pick them up as we go over my half hour here. So obviously, like S&P, as our prior guest is talking about, you can see, I mean, a lot of prior support in here right around that 550 level. And you can see on the 1 day kind of almost record or near record rally, right? The NASDAQ composite had its second best day in history last Wednesday on the 9th of April. And you can see we ran right up to 548.62. So literally within less than a point of that prior low area there. So the point being that, okay, you're about a point off of that. And now, of course, the 20-day moving average in gray here is overhanging with the last few tests of that have failed. The yellow line, this is what I wanted to start with. The yellow line, you all heard about the 200-day moving average, right? 200-day moving average, of course, this is pulled out of TradeStation here, but you can see it's as simple as it gets. Simple 200-day moving average. Nothing fancy about that line, but boy, is it effective, right? When we broke down back here in early March, to mid-March, the rally back up that hit into the 24th and 25th, ran into that resistance. Of course, we had the overhead of all the prior 580 support that was kind of also lurking overhead, but the 200-day held it like a champ. We might have gotten a slight close above it 1 day. I'm always a big believer in saying 1 day, one bar, one candle, whatever you're looking at does not make a trend, right? You're looking for a series of things happening. So let me just also recount what else is on this chart, but that's got to be looking at the 200-day as our guide on what's the overall health of a market trend up or down. Obviously, this one graded negatively once you had two closes below it. The retest basically showed, and then the breakage that, of course, happened into the Trump tariff surprise, big shot down. And so this retracement still looks like a bear retracement. We've got my acceleration bands. It's a 20-day acceleration band here on a daily chart in this fuchsia colored line here, 20 days there. Also, these white lines are what I call the big trends bands that are a visual on when we're staying between the 20 and 80% ranges on the percent R, which we're stuck in the middle of that right now. The bear phases for me are when we get broken down below that 20% and keep dropping. You saw it there. You saw it again post tariff announcement, that quick spike down. That's where the bottom can fall out when you're below that 20% and trending down. We had one of those back there April of last year as well, right around the same tax time as we're on tax day today. But you see on the bull side, when we're above that 80% line of percent R, this is Larry Williams' percent range indicator. I often call it percent T, tongue in cheek, but truly my best trades happen when we're in the top 20% for bull trades, bottom 20% for bear trades. So that's outside of that upper white line for bullish big trends bands and below that lower white line for bearish trends, especially below the long-term average here. Right now, we're in the no man's land. We're kind of right back to about the middle of the range. As you can see, the percent R is reading 57%. We're slightly above middle looking back over the last 6 weeks worth of action. We've also got the CCI on here. That's the yellow, little longer term version of that I use. And you can see the last time we retested when we're below our threshold value, bounce back up, that 575 retest essentially held and then ripped back down. Here we go again. We're retesting actually today. What does that mean? It means that that's now a bear retest when we test up into this minus 100 line after we've broken it down. You see the last couple of touches, two minus 100 didn't follow through, including the August quick spike down where VIX popped up in that last August market pullback. Those did not have the sustainability that this latest breakage has had on the downside. So now that we're below that threshold value and now retracing, this is a bear retest, meaning today's high, whatever it ends up being, is likely a high that holds as resistance. So I'm expecting we get another test down. Looks like that 520, 525 zone is a first test. You see 520 probably checks the boxes more than even 525. But then you can see that the lower bands here, we've got 508 on our acceleration band, then 502.5 on our lower big trends band. Expecting that low 500s test on the next pop to the downside. Obviously, we can fine tune the same analysis with intraday charts. I would typically move over, and I tend to look side by side at both the daily and then the hourly. And the hourly, you can see really get a nice job picking up the hourly acceleration down right after the tariff announcement. The next morning we gap down. That's a breakage. Everything's very clean, including this bottom line here. We talked about percent R and CCI, but this bottom line is the ADX in green. You can see when ADX starts turning up, in this case, a negative directional movement in red above the positive, that's starting off a bear trend that stays in place until that ADX rolls back on that first little gap up before then the Trump reversal that caused the big one-day wonder rally there. So the point of all this is that, yeah, we're still in the bearish trend for now, looking at it day to day, week to week, and saying we've got some work to do before we get out of it. So those that are, yes, sentiment's very negative. Of course, if you look at tools like the VIX, the volatility index, let's look at that next, DIX.X here. And you can see, here we go on the day. Let's just focus on the daily charts. You can see previously in this high 20s area was resistance, like going back to December, going back, of course, we got that one spike in early August, August 5th, that Monday morning, we spiked before the market opened to 65. It opened back closer to the mid 40s in the cash market, but you can see that was a big fear spike. You say, well, didn't we just get another one of those? We opened at 60 back here on the 7th. Yes, we did. But you can see that now we're kind of doing some battle as we retrace back into this upper 20s area. That last high there was 28 and a third. And we had one test up to about 29 and a half back here in early March. But you can see now here we are back at the 20-day average. We're back to 28 and a quarter, right? Old resistance often becomes new support. Now, VIX doesn't usually have a trending characteristic, but when it does, you've got to be careful. Okay. You've got to be careful and say, okay, we're back into kind of a key retest point here. I am concerned that we're right back into some support here. And the only other, you can see most of the time that doesn't trend, right? If I go back here for just a second to the COVID 2020 market, just to give you a frame of reference of when VIX trends, why you got to watch out. Here's VIX trending. Got the first little breakout in early 2020, late January, a little retrace back here. And then, of course, it just went vertical into that mid to late March bottom. And remember, that was really supported by the Fed coming to the rescue into early April, right? So we were hanging around that 20-day average here, and we just tested it here. So the question is, are we going to see the market follow through to the upside and kind of break some of these downtrends? Or are we going to hold and get another test back up in volatility levels? Remember, volatility in that phase got up to the mid 80s. You got to almost go back to the 2008 financial crisis when it got up to almost 90 in 2008. But here we are, right back into that 20-day average. That 20-day average is sitting at 28.22. We got within 7 cents of it. Now we're starting to reverse. Again, I don't want to sound hyper bearish, but I'm saying when you're looking for low risk entries, that's a trade where I would say, hey, this is a relatively bearish setup here where you could say, if I'm wrong, I'll stop it on a close and VIX underneath, say $28, right? The low today of 28, 29 would be another way to go. But whatever you use, you can see, yeah, we're getting a little breakage on that hourly chart under that 200 bar average on the hourly. But point is that, okay, just be careful. Don't get too jacked up that we've cleared out of the woods just yet, right? It's a very news-driven market. Of course, you look at things like the Qs; they're gonna pretty much support this same theory here that we're right into the 20-day average here yesterday at the highs in the morning on the news when you had a name like Apple jump up as the biggest beneficiary of the holdback of the tariffs for Apple, essentially. But remember, that's temporary. You can see the last support was around 210. We opened above 210, but quickly reversed it, came back down this morning to 200. So that's, again, a bear retest yesterday on the CCI high there, right off of the open at 213 or so, 212.94 officially. So close over that gets Apple out of that bear trend, but doesn't necessarily retake the bull trend. Notice on our bottom DMI lines, when those DMIs start to go red crossing above blue, and then we start breaking those lows, that's a bearish confirmation, right? And of course, Apple's had a couple of those here recently. But the point of it is, I mentioned Apple just because it's such a big part of the indexes, right? Compare it to back when it was really rolling last year. And you see, we've got our CCI breaking out. We've got our move outside of our acceleration bands. We've got ADX starting to trend positively. That's back in early May. And Apple announced that Apple Intelligence read that incredible move. We managed to get a nice piece of that for about a 10 bagger in one of our option strategies. That you see that just incredible move from 195-ish where we bought in there. And then the next 2 days it went to 220, right? That's what we look for as option traders is speed. I've got a need for speed when it comes to buying any kind of premium. I need to get that big payoff, big bang for our buck. Obviously, Apple had another one of those nice moves post election in early November, where it started to really trend there into the most of December, right before the new tax year, new calendar year hit, and obviously the time that maybe people take some chips off the table. So again, I'll show you a couple more indexes, and then we're gonna look at some individual stocks. So type in any symbols you want to look at. But I got to talk gold here, right? Gold has been the big story. You're looking at obviously record deficits and a relative uncertainty, and so we look at the daily chart and say, what a trend gold has been on for quite a while. right? And you say, well, gee, didn't it just get that little shakedown? Yes, it did. But you see, that's kind of right into one of these, what I call a DMI kiss. When the Bears try to take the ball from the Bulls right there on that crossover back on April 7th, I watched that low real closely, right? If the Bears are going to take the ball, they're going to have it closed below that key first cross point low. Instead, the Bulls retake it, and the stock and GLD gold prices tracking their rips higher. Same thing happened back here February 28th, another nice retest. You can see maybe we had a slight violation of this one here back here in December 16th. Yeah, violated. A couple days later on the 18th, you would get stopped out for a small loss if you put that trade on. But you see, you get right back on the wagon when the Bulls retake the ball. If we get a close above that high, which was January 2nd, start of the year, 245.5, and a few days later, it's 245.86. Bull confirmation ever since, right? From 245 now 296, right? And you can also track vehicles like GDX, the gold miner stocks, very similar type of a picture there, right? So we're seeing, a lot of accumulation of gold in comparison, of course, bonds. The volatility of bonds on the downside, everybody's surprised by that. Look, the 200-day, besides this one-day attempt to retake it right here, which had a really nasty close, and say, well, wait another day, see if we can get through that 200-day, and it rips to the downside instead. And by we said the 8th or so last week, Trump was starting to get concerned into the morning of the 9th that hey, the bond market's not reacting like he had hoped, and he pulls back on his tariff threats, at least temporarily, right? So the question is, what happens from here? We will see, but really like to see that the bonds stabilize somewhat, so that'll keep the interest rates from going too high, which of course puts a real economic slowdown impact on folks who are affected by higher rates, which is pretty much all of us when you talk about loan rates and any kind of payments on just about any type of thing, whether it's a car or otherwise, are going up when the rates are going up. So housing as well, of course, very impacted by this. So as we get a few comments here, speaking of gold, Barrick, yeah, says Auckland, yeah. So here you go, Barrick. Not my favorite gold stock, but obviously it's one of the big names, right? You can see here it is right back to the old highs. We're back up into that. You can see 21, 21 and a quarter area, 21.35, 21, 21 and a quarter, and our upper band is 20.98 on the acceleration band. So that's where I would expect to test near 21, 20.98 is what my bands show, and that should be probably a resistance point. If I compare that to some of your other choices, one that's been more of one of my favorites is AEM. You're talking about Agnico Eagle, and you're looking at this and saying, man, look at the difference, right? Look at how it keeps making higher highs. And it's a bigger name than maybe somebody mentioned Harmony earlier. But the idea is that, you look across a lot of different names within the gold space. You want to own the stocks that are leading, the stocks that make new highs on each successive test point, not the ones that are just returning to prior highs, right? So like a name like Newmont's probably the biggest in the space, but I'm not trading it, even though it's had a great run here just in the last week, right? That was a great quick run if you're watching your intraday charts, and you'll see when you see that speed of run here, which really helped Newmont go from 43 to 55, 56 almost. You said, gee, that was the most profitable trade probably of all the major golds in the last week, but it has lagged for so long. And now we're right back up into these old resistance highs, 56, 56.30. Yeah, it made a slightly higher high up here towards 50, almost 59. But the point is that, and you'll see it on the intraday chart, right? All my indicators should tell me, yeah, there's my ADX upturn there midday on the 9th as Trump makes his announcement. You can see my CCI is following along after my percent R usually is going to signal first for me along with the ADX, but both of those are signaling. CCI wouldn't confirm it until this higher close right there. Then you look for buying those little white line big trends band retests here. And you can see we got one yesterday morning on the early pullback, and it bounced a little bit for Newmont as well. So it's still long on that hourly, but I don't really like Newmont as much on the daily compared to an AEM. Obviously, there's been other names like Goldfields, GFI. It's had a big move. Get a little worried, though, when I see this little hanging bar out here. You know what that's called as a technician? That's an island. An island means that you gapped up one day, you gap down the next. This bar is left alone as an island. That's usually kind of a bearish reversal pattern when you see that island up gap, then followed by an immediate down gap, and leave this island hanging by itself here. So be careful on that one. When I see an island, you see a different island happening, bullish island right here, opening down, then opening the next day up. Even though it was a red candle, it was setting a low in place and trending on up. So be a little cautious there. And I'm really looking at AEM as my lead gold name. What about Halo? We got some names that I haven't followed quite as closely, so let's just see how the charts look. Halozyme therapy. Okay. So again, sometimes it helps on these, especially when I've not looked at it before. Like, okay, you look way back and you see, like we said before, 65 an old high back here, August of last year, 65 and a half. We trade slightly above it to 66, but we close at 64, right? So 65 has been rejected here. So you say, well, it's coming off the 200-day. Isn't that good? Yeah, in a longer term sense, that's okay. See my DMI lines, I've lost some of my support here. It's just getting a little bit marginal here. And to me, that's not something I want to mess with, right? I'd like to catch it while we've got all my indicators kind of staying in this really nice breakout mode here. CCI comes in for a retest. DMI lines stay intact. They stay intact right there as well, right into that short-term low, August 5th. That was when the market corrected, remember, at the low. And so, yeah, percent R can be a little bit more volatile, but the point of it is, you see how we started to lose that support right in here in September last year and told you to take a little pause. Of course, when it went bullish and ADX started to trend back here January 8th, you got a nice run. ADX bending down is not a problem for me as long as those bends hold, but that last bend violated once that rolled over bent right there. March 31st, that 62.60 would need to hold in my book, and it closed at 61.87 at the start of April. No fools there. Say good out, time to move on. And we retrace back to that April 1st level. I would consider that a source of funds and looking elsewhere personally. Obviously, with the biotechs, you get all kinds of news that can drive these things. I get it. But to me, you got to think in terms of your relative better sources of capital. What about KTOS? Okay, so Kratos Defense and Security. Defense, relatively hot area. 200 days been very good to this one. You can see a couple nice tests right down into that. Nearly got it here on that April 7th pullback. Nice reversal, but it's kind of in that range, right? You see that we're stuck between about 25, 25 and a half, or 26, and then our resistance looks like it's hanging in that 34 to 35 zone. So to me, it's good, but again, one that we've been on in our stock doublers portfolio. I'm trying to think of some of the names here that we've got here. Uh, you look at let's see, I'm trying to think what was that other name, but basically we look at some of the defense stocks. Defense is a sector. Obviously, you would think about a Lockheed um, or those type of names not doing so hot here recently, but the one that's been particularly strong here in staying in our portfolio on a longer term basis is Howmet Aerospace. That's the one I was trying to remember there. And so you look at this and say, okay, if we go look at a name like HWM, there we go. Type it in here. HWM. You say, okay, well, this is on a super long term, and you say, well, gee, it got a little volatile here. Yeah, it did. But when I look at it across a super longer term chart on a monthly, again, now that I'm going super long term on you here. Nvidia has been one that's been in our portfolio for stock doubler since 2016 at a split adjusted price of $1.17, right? And you can say, gee, it's gotten a little weak. Well, it's still checking the boxes for our longer term stock doublers system. But then you look at HWM in that same mode and look at that beautiful chart outside of those bands, outside of the kind of all the kind of breakouts. Yeah, it's getting a little bend in that ADX. We came right back to that band support around 104, tested to 105, and then quick snap back to 125. In this market volatility, you want to see stocks that can snap back quickly. It's the ones that lag that give you some consternation, some problems, right? That don't seem to get the buying interest coming back in. We mentioned Nvidia. Obviously, it's been a little tricky here in the recent action because, of course, the breakage of the 200-day, right? It's had certainly its share of hype from various constituents. And of course, you see that last support level looks like 115 in general, a pretty big number. And look how we're just scraping right up into it here, maybe getting a hair above it intraday, but not really retaking 115. That gives me some concern. We're still in the net negative DMI. And I'm talking on a short-term basis. Our long-term, we still own it for stock doublers from that split adjusted price where it's been about 100 bagger, right? Obviously the idea is like, how do you stay with those, right? And so part of it is like not getting shaken out by the daily chart if you're a longer term kind of a player. But for shorter term players, I'm saying, yes, not quite the time yet. It looks like from that chart to say that we're out of the woods. And we mentioned Apple earlier, and of course, then you would have to, probably also look at your other big magnificent names here, whether it's a Microsoft, which has really lagged. You see, it really broke that 200-day earlier than the other Mag 7 names. So it's been behind the curve. Of course, a name like a Netflix is one that's still looking pretty healthy to me. Look at a big day today up 6%. You look at that and say, okay, it's really definitely acting like a relative champ. Of course, Meta's got, some concerns about antitrust and whatever. And you see after that first breakage, look on the big rally day, it ran right back even a hair above the 200 day, but then quickly gave it up the very next day, right? So that 200 day is just under 580. And so that says, okay, right now Meta is a source of funds as we wait out what's going to happen from here around that 200 day. Usually not much good happens below the 200 day except for the bears, right? So the interesting thing is when you look at these charts across some of the really kind of wild and woolly stocks like the quantum stocks this past late last year, and you say, man, what a wild move that was. Let's zoom in so you can really see it. I think it's helpful sometimes to really go back almost like you were there in real time so you can really see the chart adjust, right? So like we were picking up like these breakouts back in October in quantum names, like here's QUBT. You see, these are relatively speculative stocks. I'm not saying they're household names or anything, but you see, it just was going really ballistic, checking the boxes on my CCI breakout, staying above that big CCI threshold value, right? And that lasted until we got the rollover here back earlier this year. There's our retest, there's our violation. Yeah, you gave up quite a bit off the high with this one because, of course, it gapped down on those. The news from the NVIDIA CEO about maybe quantum's going to take longer than people expected. You see, it's been dead money since. So again, when you look at an IonQ or a SoundCloud or whatever, you'll see these big trends, and then you'll see these terminal points. But they should all check the boxes of percent R breaking out, CCI breaking out, outside acceleration bands, ADX trending, right? Those great phases is what we're into, whether we're buying stocks or buying options on those stocks, right? And so that's what I'm looking for is those next leaders that are going to give you that opportunity. One of the really wild ones was HIMS, the Hims and Hers Health, which showed just some incredible volatility. Of course, this was a highly shorted stock. So you can see it ripped up and then ripped down, right? The rip up here is happening outside the acceleration bands, percent R, CCI, everything checking the boxes, ADX trending, and then wham, the FDA comes in and says, we don't need these. You're not basically not allowed to fill the gap on the shortages are no longer an issue for the semaglutide weight loss medication, right? And ever since that gap down day, with that fundamental news shift, it's been going the wrong way to the 200 day. Would I short it here? Of course not. Don't short right into the 200 day support, but don't buy it either until you get the indicators signaling. Right now, we're into a DMI kiss point that says this could be resistance today, up just under $30 here. So for now, I'm just recounting this. Now, a couple other ones. We had TEM. Pop in any other symbols. So I've got about 5 or 6 minutes before I have to hand it over to our next fellow trader. But you can see TEM, Tempest AI. For anything AI, you would think shouldn't that have done really well? Well, of course, this one came to the market a little bit later here, back June of 24, and yeah, it got a lift, but you can see it's basically not gotten a lot of follow through. There was that one good follow through move here, mid-January to about mid-February. ADX rolled over right there on February 20th, right in coincident with about the market starting to top out. And it's been down since. Looks like a trading range. You say, okay, maybe I can buy the low of the range here near 40, sell the high of the range somewhere between 70 and 80. That's possible, but that's not my preferred way to trade because, of course, you're not taking into account market structure if you just look at flat price levels. The structure will be changing, and you need to be evolving with that. That's why I look at the indicators to tell you with the structure. Now, one of the great structured trades to start off earlier this year was Alibaba, right? Baba, the whole China trade, right? We got these big players like David Tepper, big hedge fund player, of course, Michael Burry of Big Short fame, talking about that they're adding to Baba in their China positions. You can see, look at how everything's breaking out outside of these bands here. Two closes back here in late January, January 27th. Our ADX started to click up a couple bars later here. The reminder on this is there's not just one place to get into a trend, right? A lot of people say, oh, I missed that breakout at 90. Now it's 100. What do? I'm too late. I missed it. I'll wait for 90. No, you wait for your retest of your key support level. For us, it's this big trends band here, which was actually about, on this one, it was about $99 and saying, what? I'm willing to buy it at 99 when I missed it at 90? Yeah, because the trend is evolving, especially when I got that big trends band outside of my acceleration bands. See, it kind of ends right in here, and we kind of go from a really super strong, fast trend from 100 to 140 plus to now slowness, and then, of course, the reversal back to the downside. Of course, this is looking at a longer-term system on that sell, but really my percent R sells were really saying just under 130 was a key support level. Again, it kept edging up there, and then 131. So once we closed underneath that right in here, 129.79, it was saying watch out, and indeed it ripped all the way back down to the 200-day. I don't try to catch falling knives. I don't try to buy the 200-day just blindly. Yes, there's times where you're going to get paid off on that, but there's other times where you will get your face ripped off. So you better have your stops clearly defined. What about Tesla? Right? Everybody's all negative on Tesla. Now, yes, justifiably, right now it's below the 200-day. So the 200-day rule says it's going to take a little time, right? Make more sense to really get it clearing back out over this 290 to 300 range before going in. But there is a ton of negativity built up in the media and all the other stats that we look at that show that, yeah, eventually I think there's a relief rally again for Tesla. Of course, the easier part is like post-election where it breaks outside of these bands. We had the one back there June, early July as well. So now is not the time, but be aware that there's a ton of negativity built up on it. And so in the meantime, the amazing thing is look at the names that have been trending that are not your household major trading names, non-tech names like AT&T. What? AT&T? Guess what? You can buy options really cheaply on AT&T back here in the 24 and a half area. We were looking at it, and you can see that it went over the next month. That was a 1 month move from 24 and a half to almost $28, right? And you say, how is that possible that it can make a 4 point move in about 5 weeks? And say, well, that's where you can really get a lot of bang for your buck when you're buying options on names that are not expected to be as volatile. Another name that's been a little slower here at times, but other times, like last November, had a really nice move here was Mo, part of the old Philip Morris Altria group. And again, right now it's not in a zone where I'd really want to trade it from an options perspective, but you're getting that flight to safety. You're getting that people wanting those high dividend yields, wanting names that give you some cushion while we're waiting out this a little bit more difficult market environment, right? So that's where you just really got to pay attention. Let me see what else have I missed here. Also, Sandmana, SANM, if memory serves right. There we go, Sandmana. So I haven't looked at this one in quite a while, but you can see, okay, we've been in a bear phase, right? We got the breakage on the DMI lines. We got one retest right there that indeed was the short-term resistance. Look at the retest that happened about a week ago on the big market rally day. That also is defined as resistance, right? Because our blue positive line is trying to test above the red negative. Remember, one bar doesn't make a trend. In fact, these one bar moves, one bar tests of that DMI line oftentimes will be an inflection point. And I love inflection points for placing trades where I can say, okay, if I'm wrong, I stop it out on a close above that day's high. If I'm right, I can catch some really nice snapbacks. That one has not really snapped back down. You see, it's still kind of hanging near the resistance. The other one here was a nice quick snap back down, right? But I'd be a little cautious on that one. Yes, it's above the 200-day, but I still say that the structure of that one's not really ideal, even though it's showing a little bit of underlying improvement on some of the other tools like percent R starting to get back above at least its midpoint level, but not really falling through to the upside, right? So you think about other major sectors, right? And you can do that quick. I've got like 1 more minute. So I'm going to do a really quick sector flash, right? Think about all your big sectors, right? And kind of do a quick scan on which sectors are leading. Not XLK technology, right? It looks pretty darn rough there. What about healthcare? Right? You can see really got whacked there as well. And you see got a mild bounce, but still set negative. What about financials? Got all the big bank earnings coming in, retaking the 200-day, but still looking like that general 48 level, 48.7, 48 looks pretty key. Bank of America had the good earnings today. But again, watch those reactions to the news, see if we get follow through or not. It's trying, but has some more work to do. Again, so the safe haven is more like utilities back above its 200-day. So what about industrials, XLI? Okay, very much of a broken kind of retest back of the old support, not so hot. And then what about consumer staples, XLP? Of all of them, the consumer staples probably looks the best, which takes me to some of the safe haven names. McDonald's still above its 200-day. It's been good to us for some buy the dip call trades. What about Coca-Cola? Same thing. So look for safe havens, look for places where the money's flowing. Insurance, by the way, has been one of the strongest sectors. A name like AIG, more like Travelers, I think had earnings coming out here, but basically those insurance names holding up. I'm out of time, so I'm gonna hand it back to David for our next fellow trader. Thanks so much for having me, and keep trading well and protect your risk at all times. That'll keep you in the game for the long haul. Take care, everybody.